In 2023, the world consumed 200 million more ounces of silver than every mine on Earth produced. According to the Silver Institute's 2024 World Silver Survey, this wasn't a one-off event. It was the fourth consecutive year of a massive structural deficit. This is the math that precedes a price shock. In the next few minutes, I'll show you the 4 data-proven turning points that signal this is coming to a head in 2025 and how to position for it. Let's break down the first turning point: the persistent physical deficit. To understand the gravity of the situation, we have to look beyond the daily price fluctuations of the paper market and look at the physical metal actually leaving the vaults. The core thesis here is not based on speculation. It is based on a physical shortfall that is becoming impossible to ignore. The hard number, according to the Silver Institute's 2024 World Silver Survey, is a 200.6 million ounce deficit in 2023. This is a staggering figure. To put that into context, global mine production is typically around 800 to 850 million ounces a year. A deficit of over 200 million ounces means we are consuming roughly 25% more silver than we are digging out of the ground. When you see a deficit of this magnitude, the first question a rational investor asks is whether this is an anomaly. Was there a strike at a major mine? Was there a temporary supply chain disruption? The data says no. This is the 4th consecutive annual deficit. This proves it is a structural problem, not a single-year event. We have moved from a market that was in surplus for years to one that is chronically underwater. The demand for physical silver has fundamentally decoupled from the ability of miners to supply it. When you have 4 years of deficits, you are eating into above-ground stockpiles at an accelerating rate. This isn't about what might happen. It is about what has already happened to the supply chain fundamentals. Why does this matter to your portfolio? Because in commodities, price eventually follows physical reality. You can suppress the beach ball under the water for only so long. Eventually, the physics of supply and demand assert themselves. We are seeing a market that is structurally broken, where the physical consumption is stripping the shelves bare, yet the price has not yet reflected this new reality. This divergence is your opportunity, but only if you understand why the supply can't just ramp up to meet the demand. But if there's such a deficit, why hasn't the price exploded yet? The answer lies in the supply chain, which is our second turning point. The second turning point, and the reason this deficit persists, is the inelastic supply chain. In Economics 101, we learn that when prices rise, supply increases to meet that demand. If the price of apples goes up, farmers plant more apple trees. But silver plays by a different set of rules. Miners cannot simply increase production to meet higher demand or prices. The supply of silver is remarkably inelastic. The critical data point you need to know comes from the USGS and general mining industry data. Approximately 70% of all silver is mined as a byproduct of other metals, like lead, zinc, and copper. This is the most important statistic for understanding why a silver squeeze is possible. Primary silver mines, mines where silver is the main revenue source, are actually quite rare. Imagine you run a bakery that sells bread, but you only make flour when you're drilling for oil. It doesn't matter how high the price of bread goes. You can't make more flour unless you decide to drill for more oil. That's the situation for 70% of the world's silver. A copper miner is focused on the price of copper. If the copper price is low, they might scale back production, inadvertently cutting the silver supply, even if silver prices are skyrocketing. Conversely, they won't ramp up a multi-billion-dollar copper operation just to get a little bit more silver, which might only represent 5% or 10% of their revenue. This means silver production is dictated by the economics of industrial metals, not the silver price itself. This creates a structural bottleneck. Even if silver went to $50 or $100 an ounce tomorrow, 70% of the global supply cannot respond. It is locked to the production cycles of base metals. This inelasticity is what makes the current deficit so dangerous for short sellers and so bullish for physical holders. We have a deficit that cannot be fixed by higher prices in the short to medium term. The mine supply is effectively capped by factors completely outside the silver market. So we have a supply side that is stuck. Now let's look at what is happening on the other side of the equation. Third, let's look at the demand side of the equation, the green energy shock. If supply is the immovable object, industrial demand is the irresistible force. We are witnessing a massive, non-negotiable, and growing industrial demand, particularly from green technologies. The shocking comparison number here comes again from the Silver Institute. Solar panels alone are projected to consume 197.6 million ounces in 2024. Let's pause and let that number sink in. To put that in perspective, our entire global deficit was 200 million ounces. The solar industry alone consumes 197.6 million of them. That means virtually the entire net deficit we discussed in the first section can be mathematically attributed to the photovoltaics industry. And this demand is not price sensitive. When a manufacturer builds a solar panel, silver is critical for the electrical conduction. It is the most conductive metal on Earth. While they try to thrift and use less silver paste, there are physical limits to how much they can reduce before efficiency drops. Furthermore, silver represents a relatively small fraction of the total cost of a solar panel. If the price of silver doubles, the price of the solar panel might only go up by a small percentage. This means the solar industry will pay whatever they have to pay to get the metal. They won't stop buying just because silver hits $30 or $40. This single industry's demand nearly matches the entire 200.6 million ounce deficit, even before accounting for electric vehicles, 5G, and investment demand. In EVs, silver is used in the contacts, the battery management systems, and the charging stations. As the world electrifies, the hunger for silver grows. We are moving from a world where silver was largely a monetary and photographic metal to one where it is a strategic energy metal. This shift from discretionary demand like jewelry or silverware to non-discretionary industrial demand like energy infrastructure puts a floor under the market. Industry needs the metal to function. They cannot simply choose not to buy it.